if you want to walk fast, you should go alone. But if you want to walk long, I think we should go together. The biggest hurdle in the wealth creation is discontinuing the journey. People try to say that investing into equity is risky, but I think not investing into equity markets is more risky. Asset management business is very similar to, I would say, restaurant business. Look at restaurants. What makes it going? I think the quality of food. Fine. If you get that right, people will come in. No insecurity, just recruit good bench of people, even smarter people than you, so that they can, really come along. And if you're saying India is going to be the third largest economy in the next 3 to 5 years and second largest in the next 15 years, it is very difficult not to allocate to India. In fact, today we are talking about allocation to India. Over the next 10-15 years, India can itself become an asset class in terms of allocation. Morgan Housel, Mark Howard's, all those podcasts are pretty good. Tend to, increase your bets. That's the human behavior. And similar thing will happen here. The experience explosion is going to take over.
Hello and welcome to another Z Funds Sahi Asan podcast. Please welcome Mr. Madhu Nair, CEO of Union Asset Management Company. Hello Madhu, good to have you on the podcast.
Thanks, Manish. Thank you very much for having me on the show. It's been a very interesting journey what you guys are going through, and I've been watching some of your podcasts, which has been excellent. Thank you very much for having me here.
Hey, so do you watch podcasts? What kind of podcasts do you watch?
Off late, yes, because podcasts are the in thing now. So generally, I surf. So there is nothing one particular one. Maybe economics, stock markets, history, mythology. All of this interests me. Uh, Anything very specific is, if you ask me, I think Morgan Housel, Mark Howard's, all those podcasts are pretty good. I think there is an interesting one. We Study the Billionaires.
Right.
That has got really some of the interesting episodes on podcast.
We Study the Billionaires.
That's right.
Right, let's get started. Let's start with a rapid fire round first. One leadership skill that you think you've mastered better than other CEOs?
I don't know whether it is better than other CEOs or not, but I think I can probably talk about my strength. I think as a leader, I think there are two things: thought leadership and people leadership. I think I've been able to manage teams. People leadership is what I would say, which is very important, because I think if you want to walk fast, you should go alone. But if you want to walk long, I think we should go together. So I think I've been lucky enough to have smart bunch of people and lead smart bunch of people for a common purpose in various organizations.
Walk fast or walk long. That's an interesting framework. One sales lesson you think you're still learning after 25 years?
I think every day is a learning. There's nothing very particular, but I think daily prospecting and follow-up are the two critical things when it comes to sales. I try to do it, but sometimes it doesn't happen. But yeah, try to do it, I would say.
Daily prospecting and follow-up. One mistake you made fairly early in your career that you think turned out to be a blessing?
When I look back into my career, it has been a pretty steady career. I've spent enough time in organizations, whether it is Kotak, whether it is Invesco, although the organization went through various corporate changes. We started as Religare, Invesco, and then Invesco, and then at HSBC. So all have been like 7 years, 10 years, 8 years kind of tenure. Maybe in the initial phases, 3 jobs in the first 4 years. But that I wouldn't term as a mistake, but that helped me to understand, where should I build my long-term career. So I started with investment banking, then private banking, then into asset management, and finally thought that asset management is the place where, you can impact people's life the most. So I would say it's not a mistake. 3 years, for first 4 years, 3 jobs, but it has helped. Now when I look back, I I clearly remember when I entered asset management industry, that was broadly 24, 25 years back. This industry was what, close to 1 lakh crore. Now it is at 80 lakh crores. Uh, Bank deposit and mutual fund ratio was 1 is to 12. Now it is 1 is to 3.5. So you've seen that journey. Maybe, that helped me to put into that, I can say, a part of the sunrise industry at that point of time. And today also looks great.
So you were part of the mutual fund industry when Sensex, not Nifty, Sensex was at about 4,000, 5,000?
Absolutely.
We'll talk more about that. Right. Tea, coffee, or market volatility? What keeps you awake?
Frankly, Manish, nothing, because I don't drink coffee. You saw that. Tea, probably once in a day or something like that. Volatility is the part of life. I love my sleep, so it's it's very difficult to keep me, seriously awake for longer periods. Yeah, but yeah, that's it.
Right. One rule in the mutual fund industry that you would like to change if you were to given all the power and all the authority. One rule.
Maybe publishing short-term performances is what I would say, because there's a lot of noise out there when you look at. I was talking to you earlier also. I think people look at last 3 months, 6 months, 1 year returns and get very colored and try to chase best funds, and maybe they end up, or maybe the expectations get built up really far too long, and then they discontinue the journey and the wealth creation doesn't happen. So maybe we can do something on the performance disclosure, or maybe look for more consistent measures, like consistency of the fund or something like that. Is a better measure. So if that can be changed, that's the only thing I would say at this point of time. I would look at valuations and then allocate depending upon what the valuations are. If the valuations are higher, you do what you call as STPs, and when it is really attractive, then you do really lump sum. So there is no personal preference as such. It depends upon the situation, but
Right.
I think the key is you need to invest and stay invested.
Moving on to our next segment, which is the trending news segment. FIIs have been pulling out money from the Indian stock markets for the last 12, 15 months. Rupees just hit 90. With this as the background, what do you think will be the impact on Indian capital markets over the next 12, 18, 24 months? And how will that impact investor behavior?
Sure, Manish. So when you look at the data, I think obviously you're absolutely right. FIIs have been pulling out of secondary market, I would say. So all the numbers show that. But when you look from their perspective, there have been other geographies which have been doing well. You can say last year itself, emerging market, we saw a bit of flows into emerging markets. But India never got anything because India was, behind in terms of market returns. And then on top of it, you have the currency depreciation. So from FII's perspective, I think there have been alternatives, and that could be the reasons, and that because they are allocating money, and wherever they find opportunities better, they go there. But you cannot totally rule out that, because when you look at the primary market participation, FIIs have been big participants there. So when you we published this monthly market outlook at Union Mutual Fund, and we put out data on the FII flows, both primary and secondary. What we've seen in the last 2-3 years is that whatever money on the secondary side has moved out, I wouldn't say equal to that. Maybe 60-70% of the money is plowed back into the primary market also. You don't know which one what, etc. It is FII as a whole. It is net of depreciation what they get, and over longer periods of time, I think very, very strong case for India for them also to participate. When you look at, if you're saying India is going to be the third largest economy in the next 3 to 5 years and second largest in the next 15 years, it is very, very, very difficult not to allocate to India. In fact, today we are talking about allocation to India. Over next 10, 15 years, India can itself become an asset class in terms of allocation. So that's where you will see, both FIIs as well as anyway domestic market would have grown, substantially at that point of time. So next 10, 15 years looks to be, a real Amrit Kal for India in terms of stock markets.
So you're saying the last 1 year performance, which is the recency bias, the investor, the domestic SIP book, the domestic Indian investor is now fairly well educated and will not be swayed too much by this last 1 year return, and they'll continue to invest at least through the SIP book. So that's one takeaway I had from this.
Yeah. So I would agree with you on that, and I would put some data out. I think the best way to look at is not only the incremental SIP book, how 5 years, 10 years long SIPs and the number of SIPs and the amount is increasing. And that's what we are seeing. Although obviously 30, 40, 50% of the SIPs would be less than 3 years at this point of time, because the investing into SIPs have taken up, substantially higher in the last 10 years. And it will keep on happening. You will always have, at the rate of which new investors are coming in, you will always have less than 3 years SIP as the bulk of the SIP book. But they will get to 5 years, 10 years, etc. And the beauty of SIP is, when you look at a 5-year SIP, your contribution would be 80-90% of the total amount. But when you move it to 10 years, it would be 60-40. When it is like 15 years, it would be like, 80-20. And believe me, 20 years, because I've been running SIPs for 20 years, your contribution looks to be 10% of it, and 90% would be accumulated. So that's power of compounding and what these markets can do. And I also have another theory, by which I've been talking about, and that's well, happened in all the markets, whether it is US, China, Japan, etc., which I call it as Excel sheet explosion and experience explosion. And what happens during the initial phases of any product, and especially in financial services, because it's all concept selling, we all, carry Excel sheets and returns and try to convince people. And that time the adoption is 2 or 3 times, over the first 10, 15, 20 years. So it is in multiples. But once it gets onto the portfolio, you can see me, right, when I started and talking about it, but now it is getting, really, really, the passion is getting onto me. And because you have experienced that, it is there in your portfolio, then, the experience explosion, overtakes. And that can be exponential. And that's wherein I'm saying this is just the beginning, and the rate at which it will now, you can call it as an S-curve or an inflection point or something like that. And it's nothing but human behavior, right? When you go to any casino, let's say you go to a casino in Goa, initially you will start with smaller bets, and as you start winning more and more, you tend to increase your bets, and that's the human behavior. And similar thing will happen here. The experience explosion is going to take over, because we have not even scratched the surface of even existing investors. So much so to do, and then plus new investors. And what it does is that when the experience talks, then it is very infectious. You go and talk to your friends, and that belief is there. So then somebody else starts, etc. So I think it's a very powerful. This is called as network effect.
Yeah,
it's very, very powerful.
So when the experience happens, the wealth effect will kick in, and it will start sort of a virtuoso cycle.
Virtuous cycle.
Right.
It's absolutely right.
There's been a surge of IPOs in the market, in the capital markets lately. And there's been a lot of comment on whether these IPOs are overvalued or if the pricing's right. How does an AMC decide whether they should participate in an IPO or not? And a follow-up on that is, do you as a fund house also feel pressurized to participate in some of these IPOs because that's what the consumer is asking?
I'll take the first part first and then get on to the second part. Uh, so, and I don't know whether I will not be able to comment on other AMCs, how they look at, but broadly, how we look at, we are very, very valuation conscious. And, so we have avoided a lot of IPOs which has come in the recent past, but we have participated in some of them. We have participated in some of them even after the IPO. We've not participated in the IPO, but then at some point of time when we feel that the valuations are right or probably the price is right, we have got into them and stayed onto them. So it's not that we don't like what we see in terms of businesses which are coming into IPOs, but we look at valuations very closely. And sometimes what happens is that, especially in the IPOs, and with all the ecosystem around, companies tend to price a little higher. And this could be exits for some of the existing investors or maximizing things. I've not seen too many companies leaving, really a lot of money on the table. Unlike in the past, it used to be, leaving a lot of money on the table so that, over a period of time, the experience of retail investors are pretty good. It's like NFOs and mutual funds. Everybody gets on to launch, lot of themes which are there, very, very popular, even though the valuations can be much higher. And what it does is that the initial experience of investors get very disturbed and they don't continue the journey. And the similar way here also, it doesn't augur well for the long term in terms of this thing. So we believe in valuations clearly because most of the businesses what we see which come and hitting the IPOs are has got very strong potential and are really good businesses. Have we participated? Yes, in some of them. I think we have avoided more in the recent past because of I'm sure the stretch in valuations, but we are closely watching it at appropriate time. We may, at some point of time. If you ask me, is there a pressure? No, because I think we will do what is right for the investor. That's very important for us. And we also look at mandates. For example, we run a fund called Union Innovation and Opportunities, wherein we look at all these new businesses which has got some newness in it. Some of the, if you look at the portfolios, you will see some of them in those portfolios, wherein people have come in and we have gotten at appropriate time. But what you also asked me, whether there is an investor expectation. Investor may want a lot of things, but I think we should stick to what they need. That's very, very important, because anything which is very, very popular may not end up well in stock markets, is what we have all seen, right? So, luckily for us at this point of time, we don't have any very large size funds wherein we have a lot of cash left and we have to catch up, etc. That also sometimes, plays on your mind. It is like effective capital allocation at any point of time, any business. When you have a lot of capital allocation becomes a challenge. Luckily, we are not at this stage at this point of time. We are a growing company. So I would leave it at that.
That have sort of stayed constant and you've always stuck to them over these years.
I think, I've been very lucky to work with all this organization, and more than that, work with people, good people, good, honest people, smart people, I would say. As there is a saying, people leave their bosses, not their organizations, and it's true in most of the cases, and have been great learning with most of the people whom I've worked with. Uh, and these are different learnings, because you've gone and worked with organization, and it's very situational because the organization may be in very different stages. For example, when I was with HDFC, it was a start of private banking, and it was such a close knit. The entire top leadership was accessible, and and private banking was the in thing at that point of time. And it was, it was a very, very enthusiastic newbie kind of stuff, going and talking about markets as a 22, 23-year-old guy, and talking about mutual funds to people who have really made money and have been successful. So when I think back, it looks a little uh, conflicted at this point of time, but that was it. At that point of time, it thoroughly enjoyed. But I would say then Kotak happened, and Kotak was a very, very and before that, I think I should mention Kothari Pioneer, an excellent organization. It was the first private sector mutual fund. I'm sure you heard of that.
Which later became Franklin Templeton. Franklin Templeton bought their
That's right.
business.
Excellent. And it was far ahead of times, I would say, with, very, very strong charismatic leaders, Vivek, Ajay, Ravi, all of them, and they nurtured us pretty well. Uh, Clearly ahead of times, in terms of mutual fund industry. Enjoy that stint. Could I think what I learned from there is, you attempt everything under the sun, think out of the box. That's been the culture of that organization. And then move to Kotak. Kotak was shaping up the asset management business. There, it's a mix of conservatism and how do you tackle through difficult times, and then you had a run, etc. And how do you build businesses? So all of this came through in that phase, in a very, very conservative manner. That's what I would have learned in Kotak, and also people management. Very, very important. I think Kotak was the home ground for a lot of talent, and luckily I was a part of. I think that time they used to call it as junior Kotak leadership team, and you're picked up and trained for various things over a period of time, and that has immensely helped. So not only your business, you get a view of other businesses also. You work with mentors from other businesses. That's been excellent, and you get so you're well regarded, and you move on and take on huge responsibilities out there. And luckily for me, wherever I've done my stint longer in organizations, but I've not done a role more than 2 years. Something else comes on and something else adds on. This all adds up to the learning. And I remember one of the bosses early in Kotak used to ask me, what's your experience and what's your learning experience? Both can be different, and if your learning experience is more than your total number of years put in, I think you can significantly accelerate your career. And probably I was lucky enough to understand that early. Then Religare happened, and that happened at a time when financial crisis happened, 2008. But we were a bunch of young, go-getters, I would say. All of us were young for the roles which we had taken over, whether it was CEO, whether it was CIO, whether it was I used to head the institutional and the international vertical. So for all of us, it was an upgrade in the role, and I think we all had a point to prove. It was a very strong entrepreneurship kind of. So I would call it as a anything between an employment and an entrepreneurship. Although Kotak was also pretty entrepreneurship. But this was like an entrepreneurial kind of role, and promoters had given us all the freedom to build business. And that was a very, very strong journey. We had set up from scratch, built teams, did some acquisitions, very interesting. And moved on and then went into international markets. That's wherein got a chance to, although at Kotak we had done some bit of international markets, but uh, at Religare we really went all out across marketing India capability. So that was a great learning. Again, going, into um, finding a partner and getting a large name like Invesco into the country was, and we had a very, very fantastic team, I would say. So, that was a remarkable achievement. And then carrying along with Invesco in this country and, getting across nooks and corners of India, building distribution was a very, very strong experience. Then came HSBC. Again, starting. So if Religate was building from zero to whatever it is, and then Invesco, etc. But I think HSBC was lying pretty low at that point of time because HSBC was completely absent in the asset management market from 2011 to 17. But that provided me an opportunity to build new products, build distribution, and scale that up, and then finally acquire L&T Asset Management and scale up. So when I look back, I would say, from a functional perspective, you get an exposure across the entire asset management industry. You work with the best of the investment guys. You work with operational guys. Then on the sales, marketing, products, geographies, international markets. So you get very this thing. But I think one common thing which has stayed with me is building people. That's been the forte. So as I said earlier, also recruit smarter people than you and try to lead them and probably walk along with them. I think that's helped. So when I look back, I always have this metric of so as you the span of reportees and as you lead larger teams, it's your direct span of reportees, right? And maximum is 6 to 8 reportees at any point of time, and then you have larger teams. So I don't think so. I would have lost more than 2 or 3 employees in the entire career with my direct reportees. So that has helped. I think team building. I think people leadership has always stayed on with me.
Right. So stick your neck out and back your people.
Back your people. Absolutely. You recruit smarter people than you. Give them a purpose, give them a vision, and then back them up.
There are multiple stakeholders, right? There are the investors who are trusting you with their money, and then there are markets. Which of these 4 stakeholders you find most challenging when it comes to managing them?
I think team management comes to me easy. That's what I think. Over a period of time, when I look back, it's my natural style. Stakeholders. But when you look back, and look at any business for that matter, I think the center should be customer. The starting point, in any problem you try to solve or anything what you do, if you focus on customer and do the right thing for customer, I think over a period of time, everything will align.
Right.
The distribution, the teams, the employees, every stakeholders, finally it's all the outcome which happens. So that's what we are focusing, and that's what I have been focusing at any point of time. How to serve the customer and get better and better in doing that. That's what I would focus on. So there is no one metrics. It is very situational, and at HBS I've done a case study on this, managing all this, whether it has to be employee first, it has to be customer first, it has to be stakeholder first, etc. And at various points, in the same organization, you will have to prioritize. When you're going through a crisis, it would be, the order may change. When you're going through any other different problem, it would be very different. When you're going through a very, very good time, it would be very, very different. So it depends. It's very situational. How do you prioritize? But as you rightly said, there has to be a balance, and that's what we all try to do, try to balance everything together. And so far, I think it's been a good journey.
I miss the board. So when the board meeting gets really hot, how do you cool yourself off?
No, I think very interesting, and we have a very, very strong, and that should be, I think board has a very, very strong role to play in organizational success and strategy. When I look back, some of the failed organizations, most of the times it's the board which has failed. Although people will not admit that, but either probably board was not able to give the direction or strategic or expectations. It can be anything. But we have a very, very strong board, and both with the sponsors, both from Union as well as Daiichi, and also a very strong independent board. And all of them come in with various different skill sets, knowledge, expertise, and they contribute immensely to this business. So it's not easy. There have been immense debate. As a practitioner, you're on the ground, and you face the market, you face the heat. You can't, and what's happening on the ground. So, there has to be a balance, and there are arguments. It's not that, and it is healthy arguments. But the principle which I use is, and it's very much applicable across the spheres in life. You fight the issues, not the people. And that got very much ingrained in me from Kotak days, and then it just sharpened in HSBC because you have multiple stakeholders, and you have to build a balance and run it. And when you focus on issues, I think automatically things get sorted out. And that's wherein, over a period of time, you don't, because that, what you're putting forward may be the best thing for the customer, for example. And if that has to go through, if that requires some convincing, and what I've seen is that if you put the right things there up with logic, data at various contexts, I think it happens. It happens.
Which is the one overrated matrix that we associate with mutual funds, that clearly recency bias when it comes to returns.
I think
the last 1 year, 3 year returns.
1 year, point-to-point returns. I wish there was certain way wherein publicly disclosed data will be not this point-to-point. That's what I would say. Because it just colors the decision, and there's a lot of noise for the investors. But having said that, I think looking at what is in store for investors and Indian capital markets, finally, the important thing is they need to get in and stay there. My only worry is they will get in, but staying there is going to be more important, because unless and until you don't stay through the entire journey, wealth creation is impossible. Because we have seen this in most of these nations which have gone through the cycle. Finally 2, 3, 4, 5% only make money because they just stay on. Otherwise, most of them just discontinue. It's so much noise, right? F&O, trading, quick gains, all of this.
Or the noise around market to girne wala hai, abhi mat daliye.
So I think that absolutely. I think people say
trying to time the market. There'll be some expert telling you.
People try to say that, investing into equity is risky, but I think not investing into equity markets is more risky. Right. When you look at, because I don't think so there is any asset class which beats inflation as clearly, whatever data we have for any markets for that matter, over a period of time. Yeah.
So with that as background, how is today's investor different from the kind of investors you met 20 years ago, 25 years ago? Is because there's a lot more, thanks to social media and access to information, the investor is a lot more confused, or is the investor a lot more clear as to what they should expect from the market? What is it that they need now?
So when you look at, I think it happens at every cycle, because somebody will learn at somebody's expense, so that happens every time, so who have seen cycles, I think, are more sober because their conviction, as I was telling you, is much, much higher on this entire thing. and they stay on. But then the new investors are coming every day, right? And that's wherein people have not seen cycles, people don't have the background, history, data. Although, even if they have data, the real experience of walking that entire journey is very, very different from looking at data and trying to interpret. So,
excellent experience.
Excellent experience, and that's wherein the biggest difference is. And I think that's what. So there is no one bracket as such. So I've seen matured investors who obviously made the same mistakes what the new investors are going to make. But the cycle is continuing, is what I would say. And so as and when the market matures, more number of investors getting matured is a good sign. But we are far away from that. Yeah, and even if that happens, also it's not going to be that 90% of the investors are going to make money. It is always, the data shows that it is 4, 5, 6. If we can better it by even 1%, 2%, that's great.
So although a lot of new customers are coming in, the fear is the behavior is not changing.
Yeah.
And that's where, as an industry, as we build this ecosystem, we need to influence that behavior.
Absolutely. That's where a financial advisor plays a big role. That's where a manufacturer plays a big role. All the communications, everything. What needs to be there has to be addressed towards investor behavior. Because I think if you ask me what is the best way to make money in stock markets or mutual funds for that matter, I think it is not about reaching early or intelligence or anything. It is all about your investor behavior. About investor behavior. If you can stay to the course, so you have to stay through the entire course. For then you will have to choose things what is required for that. So obviously choose goals.
Get your asset allocation right.
Get your asset allocation right. That's another big thing. So that because when you choose a goal, that this is 5 years or this is 10 years. So then you try to stay through that, I think. Now the second part is, as you rightly said, asset allocation. You need to have the right asset allocation, because if the asset allocation is not right, then your experience can be very different, and the probability of you moving out of the journey can happen.
Right.
So that's where. So anything to ensure to stay the course is what we should all be talking about.
Madhu, for somebody entering the mutual fund industry as a distributor, what can they do to acquire clients?
I think first I'll talk about why somebody should enter, because I think there is a dearth. There is a big opportunity. There is a dearth, and I'll put the opportunity straight away. So I don't think so. There is any business in the world which has double engines of growth or two levers of growth, I would say. The only business, because when you look at other businesses, whatever it is, pharma, manufacturing, whatever you produce, you sell, you get the revenues, right? That's only one lever of growth. Here, I think in asset management and wealth management or distribution business, I think there are two levers at work. One is whatever you do and acquire customers and do sales, etc., which is your whatever net sales you call it as. The second is the market link growth. Whether you are in equity, whether you are fixed income, there is a market link growth, right? Equity can be a little more higher over longer periods of time, but fixed income also gives you. So the asset itself grows by itself. So actually it is double-edged. So for example, just to put in numbers, let's say you are able to do 12% net sales, and overall on your assets which you have built up, you are able to build a 10% mark to market. It may not happen every year, but over 10 years, 15 years, that's where, when you build a business. So we are talking about what? 22% compounded business growth. And we have been, as asset managers, analyzing balance sheets day in, day out. It is very difficult to find businesses which can grow at a rate of more than 20% consistently over 15, 20 years. And that looks to be possible in this business.
So that's the opportunity.
That's the opportunity. And when I put these numbers in, what are we saying? Let's say 12 plus 12, 24 over next 10 years and next 20 years. So 10x in 10 years and 100x in 20 years. That's the biggest opportunity. So definitely, I think.
So be a distributor. But how do we acquire clients if we become a distributor? What are some of the hacks?
So that's where I think two parts to it. I think obviously when you start, and that's wherein I am again a big believer of platforms like you. What it does is that it gives immense amount of time for the person to sit in front of a client and understand them, because that's the most important job. Otherwise, he will start doing a lot of research, interact with people, more aims. And so all of this is confusion and noise. You go uh, attached to a large house like yours, which has got all of this taken care, the operational aspects, the research, this thing. You are giving it in platter, right? And the remuneration is good. And you have to look at compounding on the remuneration itself. So assets will grow. Then go and sit in front of clients. And maybe it starts with referrals. That's how people. So you go and you go to 100 people who are known contacts to you, and maybe 10 of them will.
So you start with reference. You tell everybody that now you are a mutual fund distributor.
You have to, and has to be very methodical. I've seen this journey because I've seen some of the largest platforms at less than 100 crores. Now they are sitting at 1.5 lakh crore, 2 lakh crores of assets. That's how they've done this, and that there is no replacement for that. Because Jeff Bezos always say, build your business models on things which don't change. It's very easy to look at trends and build business models, but that can change.
Right.
So I think that's wherein, which is important. And then you build businesses, and then you have to reinvest back into the business, which is very important. That's wherein, a lot of distributors in the last 20 years have faltered. How you not upgraded properly, not built in technology, not built in infrastructure. So depending upon the markets you serve and the segments you serve, you will have to reinvest it back. The thumb rule is 20-30% of your revenues go back. You have to be in for it for a longer period of time, and focus on clients and investor at the center. Do the right things and create clients, and then they will give you referrals, etc. But don't over enthusiastically run for new client acquisition is what I would say, because existing clients, where once you build a business, existing clients can give you enough. And so maybe 60-70% time with the existing clients, and then 30%.
And that's what will differentiate a good MFD from an mediocre or an average MFD.
Yeah. So I think engagement, I think that's going to be, because it is all about behavior. It's all about emotional. It is all about getting or bringing rationality into the investment and make them stay. Because I think otherwise nobody will benefit, whether it is investor, distributor, manufacturer. You have to stay through this entire journey. Everybody in the ecosystem will benefit. Lage raho. Badna hai to lage raho.
A word on Union Consumption Fund. The NFO is on.
I would say, we are very, very optimistic about. So India, when you look at India, I think consumption is not a new story, right? India has always been 60-65% consumption. But we think there are, right levers which will move this current consumption into a next orbit. And that's where we are positioned at. And we debate a lot before launching products. So it's not by sales demand or something like that. It is always by investment argument for the next 10-15 years. If Harshad, my CIO, and this entire team believes, then we go for it. So I think structurally, the issue is when you look at the index of consumption, a little backward looking. Tomorrow's winners can be very, very different from today's. So what you see in the consumption basket, because a lot of new things are evolving. That's where we are going to bet on. So, for example, the index is a little more large cap oriented. We could be smaller and mid cap. And there are right levers which are propelling it. So when you look at, obviously, the structural stories of why consumption, etc. There is rising income, demographics, or technology. All of this are playing a big role. But I think for me, government has shifted the stance. This government, when you look at first 10, 12 years was focused on infrastructure. I think last budget, it was a clear signal that we are moving from infrastructure.
Government-led expansion of the
and that's very powerful. When you look at the last 15, 20 years across the globe, it is a lot of government-led businesses which have done well. Or lot of government-led initiatives and the businesses which are in that. So, and it's a very powerful, very, very powerful source. So when you drive infrastructure, you get money into your balance sheet and then spends, right, at government level. But when you want to drive consumption, you put money into the consumers. So tax relief was the first one, up to 12 lakhs. That's a big, powerful one. GST reduction is a big, powerful one. 8 pay commission is a big, powerful one, 3.7 lakh crore. And all of this have 4 to 5 times multiplier. So this will all actually propel, and with going forward, low interest rates, low inflation, and probably reasonable good monsoons, etc. I think there is a big tectonic shift from the current orbit to next orbit.
And that's where an investor consumption.
That's a consumption. But again, coming back, I think tomorrow's winners can be very, very different. And that's wherein you need to position. And that's wherein there is a very strong probability of building a decadal team for the next wealth creation for investors.
Thank you for doing this with us, Madhu. That was Madhu Nair, CEO of Union Asset Management Company. आपसे मिलना होगा Z Fund सही आसान पॉडकास्ट के अगले एपिसोड पे.